YouTubers, good morning. Happy Wednesday morning. Don't forget to join me tonight for Trends in the Housing Market. I'll be going live tonight. Anyways, I got a really good article here from Better Dwelling that can't wait till tonight. I need you guys to take a look at this. Canada is considering a risky move to fund more mortgages with foreign capital. Ooh. I just quiver when I read that. Canadian real estate buyers were running out of land last year. I don't know if you guys know how big Canada is, but it's for people that don't know or not sure, it's a very big country. It's enormous. It can fit 12 Texases inside Canada, maybe more. Running out of land last year, but now they're running out of money. The Bank of Canada, BOC, and the Office of the Superintendent of Financial Institutions are currently reviewing the limits of covered bonds that can be issued. Okay? So bond-backed securities, guys, okay? Banks have become increasingly dependent on these bonds for cheap funding of mortgages. As we approach the limit of these bonds that can be issued, regulators are looking to raise the limit. Great problem solved, except there's few tiny issues with raising the limit here. For sure, of course there is. Start dipping into promissory crap and a bunch of stuff that doesn't exist, right? Anyways, Canada's covered bond program. Unsecured mortgages in Canada are funded by a variety of sources, but senior notes and deposits are big ones. Senior notes are unsecured and consequently have to pay a nice premium to be paid out. After all, if the issuer goes bankrupt, there goes your investment. Investors need a small risk premium for that. Deposits need cash, which only grows as quick as your clients can make money. Neither method can scale at the bank pushes more mortgage growth past Great Recession. That's when Canada got covered bonds. Covered bonds are used to fund unsecured mortgage lending. Okay? Issued by financial institutions. The debt remains on the bank's books, but are also covered by the mortgages themselves. In the event investors aren't paid, they have dual recourse. That means they can go after the bank and have claim against the mortgages. The bank and the mortgage is going belly up at the same time is unlikely. So this considered ultra secure. Ultra secure investments have low yields, making them perfect for a lot of lending. So guys, remember, if it's a low yield, you're not getting much back on it, but it is a secure thing. So the rise of Canada's covered bond market. Virtually non-existent in Canada before the Great Recession, covered bonds have seen a rapid growth. In 2007, covered bonds funded 1.1% of mortgages at banks. By 2017, the number inflated to $140 billion. That's 9.1% of bank mortgage portfolios. Most of these are denominated and sold in euros, and European investor banks have become increasingly dependent on covered bonds for mortgage funding. So dependent that they need regulators to review how much they could issue. So here's the aggregated funding sources by Canada's big six banks expressed in percentage points. So here you go, covered bonds in red. And then you have the purchase agreements right here. And then common shareholder equity. Then other liabilities. That could be almost anything. And then retail small business deposits. Corporate deposits. Unsecured wholesale wholesale funding. Then you go over here to the next graph, and then you have the whole graph again, and then there's retail and small business. So it breaks down every little color in the graph. It just gives you an idea of what each color represents, so you don't have to hover over it like this to see. But anyways, covered bond issues is getting close to the limit. So this is the problem here, guys. These 9.1% of mortgages funded by covered bonds represent 2.9% to 3.3% of total assets at the big six banks and currently limited to a covered bond issue of 4%. The Bank of Canada estimates that gives banks room to issue another $50 billion of the instrument. For context, Q1 saw 26.5 billion in uninsured mortgage originations and traditional lenders just in Greater Toronto. Now, covered bonds aren't the only source of funding for those mortgages. Banks have been increasingly dependent on them, though not leaving a lot of room for growth. So Canadian mortgages backed by covered bonds. So they're using the bonds to cover themselves or to protect themselves issued. Why? Because they are scared of lending their own money they don't even have through their fractional reserve schemes that they've been using for a long time, and they're starting to realize that they're running out of money, and they're starting to realize that if people start defaulting like they did in 2007 in the United States, you're going to see a huge disaster. But it's the taxpayers, the working poor, that didn't borrow these mortgages and didn't borrow this money that have to pay for it back anyway. So, you know what I'm saying, right? I'm not saying, like, I'm not trying to be condescending, but I'm saying that's usually what happens, right? So let's keep reading. Sources: Canada Mortgage Housing Corporation website of registered issuers, regulatory filings of Canadian banks, and Bank of Canada calculations better dwelling. Okay, rather than banks growing other sources of funds, regulators will raise the limit. So that's kind of dangerous. Earlier this year, OSFI cryptically announced that they're taking a hard look at this limit. When we asked directly, they couldn't confirm it, but it meant higher or lower. The snitches at the BOC weren't so tight-lipped, instead explaining it would be an upward revision. Riskier than we're letting on? Okay, sounds great. Let's just raise the limits and we'll be good. Not exactly. It's a huge risk. If they aren't sure that the Canadian economy is booming, this is the part right here. This is very important. And real estate prices are stable, which they're not. Covered bonds are well covered. I don't know about that. I know they're low yield returns, but still, I don't trust it. In the event that the asset in the cover becomes non-performing, it gets replenished. The banks transfer for if mortgage use for covered defaults, they have to replace it with a good one. The mortgage is likely to come from the bank's unsecured pool. Oh, God. Remember, when we discussed this, unsecured mortgages coming from expensive senior notes or deposits, those less profitable mortgages get moved to the covered pool in this event. Or I guess, low risk? That would be low risk, right? This can potentially create a higher ratio of unsecured debt, which is also the subject of its own limits. At the Bank of Canada's Tony Einhart noted, increases in challenges of banks face in responding to rapid depositor withdrawals or failure to unsecured debt holders to renew their debt. So what does he mean by rapid depositor withdrawals? So if there could be a runoff, if people start removing their monies from the banks, let's say they stop trusting the banks for some reason, which happened in some countries, they're going to start putting a limit on how much you could withdraw, because there'll be a huge monetary runoff or a runoff on the banking system. And that's happened already within our lifetimes at least 13, 14 times. In my lifetime, it's happened quite a few times, actually. The rapid withdrawal of cash doesn't seem like a likely scenario to the average consumer. After all, unemployment has never been lower and wages are booming. However, the growth in the M1 supply near cash is quickly slowing. As interest rates climb, this indicator is likely to show further showing of cash deposits. The recent phenomena of Canadians using high-interest subprime loans and buying negative carry real estate investments further depletes the deposits in the event of an economic hiccup. People will also need to draw on savings. Also makes a rapid withdrawal on scenario more realistic. Regulators are considering doing one of the most Canadian things I can think of regarding debt. Forget limiting growth to income and other traditional methods of funding mortgages. That would require banks to stop handing out mortgages to everyone that walks in the branch. Instead, they're looking to raise the limits on how many covered bonds they could issue. Right, so this way you're putting more pressure on foreign entities, more foreign capital, right? And then this takes a lot of alleviation off the banks, right? And to be very fair with you guys, it does seem like a decent idea, but the problem is I think it's all wrapped up with taxpayers. It's got a lot to do with a lot of, obviously it's a lot of government funding, but I'm saying it's got a lot to do with taxpayers. The problem is the taxpayers, the working poor, the rich don't pay tax and the dirt poor don't. So you got the middle class that's keeping this economy afloat, keeping the infrastructure rolling. They're the ones that end up flipping the bill regardless. Like, I don't know if you remember when, what's that, Freddie Mac and those guys back in the United States, when they were having mortgage-backed securities and they were packaging even bad debt and stuff. It turned out into an absolute nightmare, and banks were just defaulting left, right. The auto sector was failing. Everything was falling apart. And who flipped the bill? The working poor. Anyways, guys, I want to know what you guys think of this. I'm not going to say too much. I'm not going to be too opinionated on this one. I want you guys to comment below. I read the entire article. I want to know what you guys think. You know, foreign capital is good because now it's not so heavily dependent on the banking system. Yeah, you know, you got business deposits, you got corporate deposits, you got other things that are supporting the banking system. But I think corporate and business deposits should be a lot higher than they are. At least 15% higher across the board for both. This shows that more people are being hired, or more people are hired in the private sector. There's a lot of things, you know. I'm not going to get into too much of the bond market, or foreign funded packaged mortgages. I want you guys to kind of weigh in on this. My channel does well not because of me, it's because the people that comment and make the channel worthwhile watching. Guys, don't forget to watch Trends in the Housing Market tonight. I might bring this back up, and maybe we could go in depth with this and see, you know, it is a decent thing on paper, but is it going to work in reality? Comment below. Thanks for watching.